Earnings season is here, and some companies have been struggling while others have been performing exceptionally well. So, in this video, I'm going to be covering the earnings of two Canadian companies that I own shares in, and I'm going to provide an update of where I see those companies going in the future. My name is Paul, and so far I've invested $100 per month into Canadian securities for 31 months straight, with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. And I'm doing this series to try and show that by following a disciplined plan of investing $100 every month, the average Canadian will be able to achieve retirement and live happily off of their investments in financial freedom. The first company that I'm going to be looking at is MTY Food Group, who has been struggling considerably throughout the last year, and recently they released their second quarter earnings report. MTY is a company that owns and franchises out 90 different restaurant brands like Cold Stone Creamery, Papa Murphy's, Wetzel's Pretzels, Famous Dave's, and Baton Rouge. And unfortunately, this quarter wasn't the big turnaround that everyone was hoping for. Revenues declined by $1.5 million, which ultimately was somewhat negligible considering the company earned in excess of $300 million, but it's still not a great sign to see the company's revenues shrink on a year-over-year basis. Now, there was some very minor growth in the larger US and international segment, but the Canadian side of the business once again was the weak point, declining by 2%. This was partly due to lower sales in the franchising segment, but most of this decline came from the retail segment, which has been plummeting over the past year or so and is an absolute freefall, showing no signs of recovery, with the management continuing to blame the grocer's decision to focus on marketing in-house labels. Regardless of why this is happening, this is by far the most disappointing segment of MTY's business model. Thankfully, MTY did open up a few new corporate locations in Canada, which are putting up strong revenue growth numbers, so that did offset a little bit of the declines coming from the other segments. Meanwhile, on the other side of the border, we have almost the complete opposite story, with corporate location closures resulting in a slight decline in revenues, but that's being completely offset by franchising revenue increases and an increase in the food processing, distribution, and retail segment, where the company has finally reinstated their licensing agreement and has begun to ramp sales back up. And this speedy retail growth should continue on into the next quarter, such that the $700,000 earned in this quarter will probably more than double, assuming sales get back to where they were prior to the previously mentioned licensing contract termination. Thankfully, the overall stagnation in revenues was matched by a similar stagnation in the operating expense growth. But unfortunately, the Canadian side was once again weak, with costs increasing by 2%, offset by the US and international's reduction in expenses. So yeah, the Canadian business is looking pretty rough at the moment, but hopefully the company can get a handle on the issues facing franchising, since it is the one segment that has been both declining in revenue and increasing in expenses. In further negative news, MTY continued on its trend of net store closures, opening a total of 85 locations in the quarter while closing 90. The management does still expect this trend to turn around, but seeing how much of a challenge the Canadian side is facing, I do expect that this trend will continue on for some time until revenues start increasing and costs start subsiding, or at least plateau out. And I hate to keep heaping on the bad news, but it doesn't end there. Free cash flows per share took a pretty big hit this quarter, down almost 20% from the prior year. And unlike the other points brought up, this is one that substantially impacts my personal investment hypothesis in the company. Or so I thought. But the management did state that this was due to reduced operating cash flow, which came about because of the unfavorable timing of collections and payments made by the company, specifically coming from the accounts payable and receivable. And if we double check the company's filed statements of cash flow, this does appear to be factual, with MTY being owed about $3 million that hasn't come in yet, and the company also having paid out $8.1 million, which makes up the entirety of the $10 million free cash flow discrepancy compared to 2023. So this is not a huge issue, and we should be able to assume that sometime in the next couple quarters, there will be a positive discrepancy to counterbalance this. But that is something that we definitely want to pay attention for and be aware of for future quarters, because if negative discrepancies like this don't receive counterbalances, then they're just declines, and a 20% decline to free cash flow would be very worrisome if that happens to be the case. That said, MTY's management does have a pretty good history of being honest and truthful, so I'm personally going to be giving them the benefit of the doubt. As for the few bright spots of the quarter, the company did manage to clear off another $20-ish million of debt from the balance sheet, and they took advantage of the low share price by buying back over 186,000 shares. Also worth considering is that a lot of MTY's competition has also had poor showings, so this mediocre quarter might be pointing to some weakness in the industry as a whole and not specifically MTY. Not that this necessarily takes away from the sting of a subpar quarter. Thankfully, a lot of the negativity surrounding MTY had already been more than priced into the stock, so a blasé quarter like this one was actually considered decent and saw the stock pop upwards to about $48.50 before slowly trickling back down at the end of the month to the $45 mark. And assuming the free cash flow issue was truly a one-time thing, we should still be on track to getting another 10% plus dividend raise in Q4, as well as getting back to some strong growth once the industry does recover. The other security that I'll be covering this month is the Morguard North American Residential REIT, which owns and rents out apartment units located in growing and mature urban areas throughout Canada and the United States. Unlike MTY, Morguard's performance was strong and consistent, as anyone who's been following it has likely come to expect. Rents were up on both sides of the border, and apartment occupancy continued to be well above 90%. Plus, the management noted that these rents don't tell the full story, since the majority of units in Canada are existing in a rent-controlled environment. But when a tenant moves out, the REIT is able to charge true market-level rents, which are currently, on average, over 26% higher than the current rents being received. This means that the fair market rent on Canadian units would likely boost Canadian AMR well into the 2000s if the rent control regulations do get lifted, or if the affected suites get turned over. And that would likely have a very positive impact on the adjusted funds from operations per share, which this quarter came in at 42 cents, which is roughly even compared to Q2 of 2023. So the FFO performance was pretty solid and consistent, plus the REIT also completed refinancing on several of its properties, strongly increasing liquidity and allowing the REIT to repurchase over 500,000 shares in just one quarter, which is well over 1.3% of the total float. Now, unfortunately, because the Morguard North American Residential REIT released its earnings so close to the release of my video, Ticker wasn't able to collect and update its data on the REIT in time for me to show you exactly how this buyback looked relative to the previous quarter. And this also prevented me from showing how the tangible book value per share was impacted, which is one of the key metrics that I track for this specific security. But I will show you my estimates of where we stand today relative to the previous quarter. Just know that this data isn't exact, though it should be approximately accurate to within a few cents according to the data that the company provided. So, because of the massive amount of repurchases done at discounted prices, the net underlying asset value of each share has increased from $50.29 to $52.18, which means that each share trading at today's price of $16.51 is worth well over 3 times its current price based on the net value of the company's underlying assets. So MRG is clearly still incredibly cheap, and the REIT is now flush with over $127 million in cash thanks to their mortgage refinancing, which the management said they'll be using to continue taking advantage of the repurchase program, acknowledging that it is currently the best avenue for capital deployment. That said, management is also looking at their options for sprucing up the real estate portfolio, but they don't have any specific properties in mind at the moment, though it sounded like the US is offering more reasonable prices than Canada. Finally, there were some talks of a potential substantial course issuer bid, which, unlike a normal course issuer bid, wherein the security in question is authorized to repurchase its shares off of open market exchanges, a substantial course issuer bid allows the company to solicit shares directly from shareholders, usually with the intention of repurchasing a large percentage chunk of the total float, and usually at a moderate premium to the price that shares trade at on the exchange. And I've gotta say, that would be pretty interesting, since one of the major issues with NCIB repurchases for a REIT like Morguard is that it does have a fairly low volume of stock that trades hands on a regular basis, and that makes it hard for Morguard to acquire significant shares. Probably because a lot of people like myself buy the shares with plans of holding until the gap between the NAV and the share price has closed considerably. So a substantial bid would allow shareholders to realize some solid gains very quickly. But the only issue is that there might not be that many takers, even if their offer were, say, $25 per share, which is roughly 50% higher than where the share price is today. Because even at $25, the shares would have an underlying net asset value that would constitute an even further 100% gain. And offering significantly more than that just doesn't really seem very sensible, especially when the company is already authorized to pick up an additional 8% of the float at market value, which is a lot lower, albeit maybe harder to maximize on. Yeah, I could probably be swayed either way on this, but as for right now, I think that the company should probably just continue taking advantage of its ability to pick up cheap shares under the NCIB before deciding to make a substantial offering. So, how did this solid report affect the share price? Well, Morguard is up on the month, but shares did decline after the earnings came out alongside the broader market. And it seems like despite MRG's abnormal discount and the management's efforts to close the gap, it continues to trade in tandem with its peer residential REITs, making it a good target for prospective investors. Now, last month I picked up 4 shares for $15.79 each, and those shares have since increased in value by 4.56%, which does not include the monthly dividend that the REIT pays out. And really quickly, I do want to touch on one more company that I hold within the portfolio, and that is goeasy, Canada's top non-prime lender whose shares have appreciated by 8.2% in the month of July, going from about $185 to end the month just below $200. Now, I didn't buy any shares of this one last month, and I probably won't buy any this month either, just because the price point is towards the high end of my buying range for the company, and because there are some unknowns regarding the upcoming CEO transition. That said, with all 3 of the portfolio's holdings putting up positive returns, the portfolio did make a solid push upwards and did manage to turn positive for the first time in quite a while, ending the month at a grand total of $3,271.73, which is up almost 1.2% on the $3,233.69. And the book value figure here does factor in reinvested dividends as invested capital. But if we don't include the reinvested dividends and only look at the money that I've personally put into the investment account on Wealthsimple, the portfolio would be up over $171 on the $3,100 that I've personally deposited. Taking a look at my portfolio versus the benchmarks, we made up a lot of ground in July and surpassed the previous peak of $157 in gains that the portfolio achieved back in early 2023. On top of that, most of the benchmarks had comparably modest results, except for the Global Value ETF, marked with the pink line. On the other hand, the worst performer this month was the S&P 500, which has had such an incredible run-up that despite its poor performance, it is still in first place by a wide margin. Unfortunately, despite my portfolio finally starting to string together some decent gains, I am still in last place, and I do still need the portfolio to grow another 9.5% in order to catch back up to the goal line marked in red with the stars, representing an annual 12% return on investment. Okay, so I've already put this month's $100 in the account on Wealthsimple, as you can see on screen now, and I also have some earned dividends from last month ready to be deployed. So the first thing that I'm going to do is buy 5 shares of the Morguard North American Residential REIT to once again take advantage of that massive discount that I keep harping on. And with that done, I'm going to be putting the remaining cash into a fraction of a share of MTY Food Group, since I do still believe that things will turn around for the company over time as its stronger banners become a larger and larger percentage of the company's franchise operations. Taking a look at the end result of August's investing, I was able to pick up 5 shares of the Morguard North American Residential REIT for $16.58 each, and 0.6266 shares of MTY Food Group at a cost basis of $43.50 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, August the 2nd, the portfolio now has 143 shares of the Morguard North American Residential REIT worth roughly $2,368, about 15.2 shares of MTY Food Group worth over $662, and the same 1.62 shares of Go Easy, which are now worth about $313.50. Moving on to the dividend tracking chart, in July, the portfolio brought in $10.16. Most of which came from Morguard's monthly distribution, and the remainder coming from GoEasy's quarterly payout. That's enough to buy this bottle of healthy bones and teeth vitamin gummies. I don't know, I'm kind of running out of ideas for items in the $10 range, but thankfully I won't be stuck here for too much longer, since next month is expected to be the big record dividend for the quarter, projected to be coming in at a whopping $12.60. But not all the exciting milestone news is coming next month. Right now, the cumulative dividends earned in 2024 has officially surpassed the total dividends earned in all of 2023. And on top of that, we're nearly 50% of the way to the $130 cumulative dividend goal for fiscal 2024. So everything is coming along quite nicely. Taking a look at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $130.49, which is a 3.49% increase from what was expected last month. And that's now more than the cumulative dividend income goal that I hope to hit by the end of 2024. As for the portfolio's percentage yield on contributed capital, this month it has jumped 1 basis point to 4.08%. And that's going to conclude this month's episode. So thank you all for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities, so again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.